You could have positive expectancy and you could have a massive gap down tomorrow, minus 20% in your portfolio value. Nothing's preventing that. It might be extremely unlikely, but if you're not modeling the tail risk correctly, then your model could be lying to you. It could seem unlikely, but what if it's more likely than you even expect because you're missing a dimension of risk? I have a really cool animation here to show you why walk forward validation fails. Imagine you're running a volatility risk premia harvesting hedge fund. Okay. It's 2002. You've just experienced the dot-com bubble, and now you have this empirical probability of tail risk. You've observed these crisis events. All right, now what? You're going to use that to determine your position sizing. I'm going to use that empirical data to inform how much I should take in terms of risk on each trade. Use my value at risk, my conditional value at risk, my expected shortfall to see if I can survive and make it to the long run. I want you to watch what happens. Even with this quantitative approach, when 2008 rolls around, the empirical probabilities, the empirical data that you've observed in 2001, it does not even remotely proxy for the losses experienced in 2008. That is what I'm saying is this walk forward validation failure. You have no idea what's to come. You have no idea. You take a look at these empirical distributions, probabilities, and statistics, and they may be useful to inform the amount of risk that you're willing to take on a particular trade or your positioning in a portfolio, but that does not indicate your ability to actually survive these tail risk events because not one of these black swan events are going to be equivalent to another. That's a really big idea here. So it's not just about taking the data that we've already observed and then mapping it to our portfolio or trades and we're good to go. No, it's about how much risk are you taking and what does your survival probability look like in a 20, 40, 60, 80% shock to what is expected. That is what I'm talking about here. You can't just blindly use walk forward validation and your model and parameterization that, survived that walk forward validation process and expect the same results in the future. You can overfit in a walk forward validation process. If you tune your hyperparameters to death, that's what you're doing. You're just overfitting then the walk forward. You always have model and parameter risk in the real world because nobody knows what's going to happen next. That is why it is about positioning, not prediction. We're never trying to predict anything. We're trying to aim for optimal distributions, probabilities, and statistics for positioning and survival, much like a casino. Think about it this way. If a big player comes into a casino and he wants to bet $100 million on red, the casino, even with a house edge, may not want to take that trade. Because if they lose, what if they run out of money? That is a very real possible state of the world. The same thing is exactly true in this simulation that we observed here. We were taking what we assumed to be risk that, we could manage and we had an edge, and we take a look at historical crises to inform our position sizing, but then what? A new crisis that we hadn't experienced and weren't prepared for blew out our account. It is about positioning and survival. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.